All right, let's dive right in. Today, we're doing something I think you'll find really interesting. We're taking a real live company, Devon Energy, and putting it through one of the toughest investing challenges out there, the Warren Buffett test. So, is it a buy? Let's find out.
And this quote, right here, this is our entire playbook for today. It's from the man himself, and it's so simple, but wow, is it powerful. It really boils everything down to two crucial questions. First, is the business itself a great one? And second, is the price you're paying for it reasonable?
And that's the big question, right? How does Devon Energy actually measure up? So think of this as a detective story. We're going to follow the clues in the data, piece by piece, to see if this is a company that Warren Buffett might even glance at. Okay, first things first. Part 1 of our investigation. Buffett is famous for not messing around with so-so businesses. He's hunting for what he calls wonderful companies. You know, ones that are just consistently great at making money. So, our first job is to check out Devon's profitability. This is really the heart of the matter for this section. A truly wonderful business isn't just profitable this year. It's a money-making machine, year in and year out. It needs to be consistent. So, let's see what the numbers have to say. So here's our first set of clues, a quick snapshot. Return on equity, or ROE, basically tells us how good the company is at making profits with the money shareholders have given it. Return on invested capital, ROIC, is similar, but it includes debt too. And net profit margin, well, that's just how much of every dollar in sales becomes pure profit. And you know, looking at these numbers in isolation, they look pretty respectable.
But here's where our investigation gets a little more complicated. When you compare the current numbers to what they've been averaging over the last 3 years, a totally different picture emerges. I mean, look at that ROE. It's dropped from over 32% down to 17%, and the ROIC has been almost chopped in half. This is a huge deal. It tells us that while Devon is making money now, its profitability is really cooled off. And that word, consistency, suddenly looks a little shaky.
And here's the smoking gun for why those returns have been falling. The company's actual bottom line profit, its net income, has been shrinking, and not by a little, by an average of almost 24% a year for the last 3 years. Now, if you're an investor who lives and breathes consistency, like Buffett, a trend like that is a major, major red flag.
All right, let's pivot to the second part of our investigation. A wonderful business isn't just about profits. It's got to be built to last. It needs to be a financial fortress, something that can handle the tough times. And for Buffett, a huge piece of that puzzle is how a company manages its debt.
So the main tool we're going to use to check this is the debt-to-equity ratio. Now, it sounds complicated, but the idea is super simple. It just asks how much of the company is paid for with borrowed money versus the owner's own cash. A high number means a lot of debt, and a lot of debt means a lot of risk. Buffett, as you probably know, hates taking on unnecessary risk. So what's Devon's magic number? It's 0.54. Now, as a general rule, anything under 1.0 is considered pretty darn healthy. This basically means Devon has almost twice as much of its own money in the business as it does borrowed money. That is a very, very solid foundation.
And check this out, it gets even better. Not only is the debt level low right now, but it's actually been going down. It's lower than its recent average. This tells you that management is actively being responsible. They're paying down debt and strengthening the company. That is exactly what you want to see. This is a huge check mark for Devon.
Okay, so quick recap. We have a company that's financially rock solid, but one whose profits have been a little inconsistent lately. Now we get to the second half of that famous Buffett quote, can we buy it at a fair price? This is where we stop looking at the business and start looking at the stock itself. And the key concept here, the holy grail for value investors, is the margin of safety. The easiest way to think about it is like this. You want to buy $1 for 50 cents. You figure out what you think the business is really worth, and then you demand to buy it for a whole lot less. That discount, that's your cushion. It's your protection, in case you're wrong.
So what kind of discount are we talking about for Devon right now? A massive 40.14%, according to our model at least. The stock is trading for significantly less than its estimated fair value. This is a big one. It suggests the market might be scared or just not paying attention, creating what could be a fantastic bargain.
But hang on, we have to be smart about this. A huge discount sticker isn't always a good thing. Sometimes things are on sale for a reason. You have to ask yourself, why is it so cheap? And in Devon's case, a huge part of the answer has to do with volatility.
And wow, this chart says it all, doesn't it?
talk about a roller coaster. In 2021, the stock more than tripled in value, up 205%. But then you look back just a few years to 2018, and it lost nearly half its value. This is not a stock for the faint of heart. These are the kinds of wild swings that test even the most seasoned investor.
But let's zoom out for a second. In spite of that absolutely stomach-turning volatility, if you were able to just hold on tight for the last 5 years, you would have seen an average return of over 23% per year. So that's the trade-off, isn't it? It has been a seriously bumpy road, but for the people who could stay on it, it's been a very profitable one.
Okay, our investigation is complete. We've gathered all the clues, we've looked at the profits, the debt, and the price. Now it's time to bring it all together, lay it all out, and see what the final verdict is. How did Devon Energy do on our Buffett test?
Here it is, our final scorecard. So for consistent profitability, we have to give it a mixed grade. That recent dip in profits is a real problem for us. For low debt, strong, no question. The balance sheet is a rock. Fair price, also strong. That margin of safety is just too big to ignore. But then we get to volatility, and that's a low score. A smooth ride? Absolutely not. This stock is anything but.
So when you put it all together, what's the story the data is telling us? It's painting a very specific picture of a company that is financially strong and it looks really undervalued. But it also has sputtering profits and a stock price that is all over the map. So this brings us right back to Buffett's quote. It looks like Devon Energy might not be a wonderful company, but it could be a fair company trading at a wonderful price.
And that right there leads us to the final and maybe the most important question of all. The data can give us the facts, but it can't tell you what to do. Knowing everything we've just uncovered, the answer really comes down to you. Can you stomach the wild ride to potentially cash in on that low price? Does your own personality match this kind of investment? That's the real question.